Hello and welcome to this ET Now special. I'm Nayantararai. Well, 1st of February, Union Budget Day is almost here, and I've got a A-star panel from the Confederation for Indian Industry, CII, right here with me. So let's welcome the President, Mr. Sanjiv Bajaj, Vice President Sanjiv Puri from ITC. We also have our Dinesh, the President-designate of CII, and of course, Chandrajeet Banerjee, called CV, the Director General of CII. Thank you, gentlemen, for being with us today on ET Now. Well, Union Budget Day is here. We all are familiar with CII's budget wish list for the central exchequer. Start looking on fiscal management, step on the gas when it comes to disinvestment, don't get populist, cut taxes, continue to spend more. But that and more is what we're going to be discussing in detail. This is India's decade. Sanjiv Bajaj, let me begin with you. You're CII president. You have a pulse of the market. You have a pulse of what's happening with consumerism as well. You track policy so closely as well. This is going to be the last full year budget by Nirmala Sitharaman as far as this term goes. If we were to go back in 2019, when Piyush Goyal presented the budget that had been prepared by the late Arun Jaitley, can't say it was populist. So this time round, can you tell me what India Inc. is expecting? We're still vulnerable. We're still emerging out of COVID. What is your expectation?
Nayantara, what we've seen of this government, and you talked correctly at about 2019, is that this government continues to stay focused on all-round development, including economic development. And that's what we are hoping that this budget will also continue to further focus on. It's important in these times where we are in an uncertain external environment to continue to ensure macroeconomic stability in India. And that's where we believe that strong fiscal consolidation is required. The budget should adhere to our fiscal deficit target of 6.4% of GDP for this fiscal, gliding down to 6% in the next year and eventually to 4.5% by FY26. It's also going to be important that we continue with our investment-led growth strategy. The budget last year significantly increased public sector capex, and we are hoping to see a similar 35% increase in this year, which would take it to about 10 lakh crore. This is very important because it keeps the economy growing. It helps in creating more jobs. More jobs create more consumption. We also believe that an item to boost further consumption demand is to rationalize personal income taxes at the lower end of the income segments. And that is because it is this group of people that have got hit the hardest through the pandemic, and high inflation hits them the hardest as well. So these are some of the initial points that I would mention, which we have seen past budgets do, and we are hoping that this budget would continue to do the same.
Okay, so you're still hoping that we see a 25% like mop-up when it comes to the government expenditure. But Sanjiv Bajaj, the one thing I want to ask you as well is that when we go towards 1st of February, the fact is the Indian financial services, the banks in particular, have not looked as healthy as they have. Yes, they might be getting rewarded on the stock market as well, but look at the way credit growth is also picking up, the way we've seen the NPA cleanup that's taking place. Is this also a union budget times to signal that India could move towards more consolidation of banks, that this is a right time to see maybe gangbuster reforms for financial services?
So there are two different issues over here, Nayantara. Banks actually are in a very healthy situation right now. They've cleaned up their bad debts from past years. They are adequately capitalized. We are starting to see credit grow, as you mentioned, and good quality capex investments are getting access to capital, and we are hoping for this to grow. So banks, NBFCs are primed up as the economy grows. The second issue is on continued either consolidation, or I believe it should be divestment of banks and the insurance companies, as was announced in the earlier budget. This is towards multiple factors. Broadly, this is because, as government says, government should not be in business, and other than a few strategic areas, this government has very clearly said that it's going to divest in the other areas. Secondly, we need revenue augmentation, and these divestments will help us in getting those additional revenues. So I know that election time things can be a little bit more sensitive, but this government has been very strong and confident in how it acts, and that's why I hope we continue to see the momentum in these areas.
Mr. Sanjiv Puri, if I can now come to you. I'm not going to get company specific, but we are in the thick of earnings season. And if we want the government to invest more, the government always says we need the animal spirits back when it comes to India Inc. Can I ask you point blank, are the animal spirits back with India Inc. with the kind of returns, profits also that we started to see, the uptick, but margins being under pressure? What kind of a budget are you expecting? What is it going to take from the central exchequer to get the animal spirits back? Your top 3 suggestions, Sanjiv Puri.
Thank you, Nayantara. So I think, first of all, let me say that as far as the macros are concerned, they are certainly much better than they were over, say, a year back or so. Capacity utilizations are better. The economy has recovered well, is resilient. I think prior to the pandemic itself, a lot of purposeful interventions made by the government, whether it's a corporate income tax rates, which makes it more conducive to investments. Banks are in much better state. So all of this is a positive movement, and we are starting to see the green shoots of investment visible at the moment. But I wouldn't say it is great. We're just seeing some start is being seen in chemicals, even in food and beverages, in metals, in capital expenditure related items. So there is something that is certainly picking up, but it's not adequate. A lot more needs to be done. And I think the approach that Sanjiv just alluded to on the investment-led growth, the investments on infrastructure, which is going to create jobs and therefore spur consumption, and that in turn higher capacity utilization and setting up a virtuous cycle. And this is important at a time when the global situation is providing headwinds. Of course, we believe that after some time, after a couple of quarters or 3 quarters, the global situation also should be better, because China is also opening up amongst others. And the general feel from Davos was that the recession may not be so severe. So in the later half of the coming year, it will pick up, but still the economy requires that support. And in terms of specifics, I would let me call out a couple of things. One is, I think the window for the reduced tax for new manufacturing industry, which was introduced earlier, there is a sunset period. I think that needs to be extended, because part of the period has gone during COVID. So now that capacity utilizations are picking up, I think this is a good time to give that impetus. Second is that there has been mention of, that the PLI has done well. It has spurred some investments. We need to focus a lot on jobs, and therefore some kind of a PLI scheme for job-intensive sectors, be it apparel, footwear, toys, amongst others. I think that would be certainly very, very welcome. I think the other area where that can go a long way in spurring consumption, creating jobs, is the promotion of the tourism sector. India is a great economy for services. We have the skilled manpower, and we have good demographics. So therefore, that's a sector and India has very strong assets as far as tourism is concerned. And the government is purposefully showcasing this during G20. So that's a great opportunity to promote it and provide some interventions in the tourism industry, so that this also can create jobs over a period of time. The economic multipliers in this sector are also tremendous. And the last I will also talk about is agriculture. I think a lot of purposeful interventions have been made in prior budgets, and the building blocks are in place. Now it's a question of continuing the journey and giving momentum to it. And can we do that by cluster-based, crop-wise, market-centric clusters which are being competitive, build those clusters also for climate resilience. Those are the things I believe will actually provide more impetus to the economy going forward.
Okay. Since you started talking about all of this, and I know Mr. Bajaj will have to go soon, so I'm going to give this question to him before he has to log off. Mr. Bajaj, if you look at it, and you have a pulse of the markets, I said that in the introduction, late 2022, we were all talking about India decoupling from the rest of the world, India being one of the best performing stock markets. It's not been a good ride in 2023. The way we're seeing reallocations take place by foreign investors, as we're seeing money being pulled out, the domestic shock absorbers are also waiting for Feb 1st. Mr. Bajaj, it seems as if the markets are convinced that this budget could have some bad news when it comes to capital gains. Logically, why would the government want to disrupt one of the best performing stock markets? Would love to get your views. With all of this banter that is going on about capital gains, should there be any change? Is there a need to tweak? Should we, for example, look at the 10-year again?
Firstly, Nayantara, the stock market is only a reflection of action that actually happens. So I would not worry about short-term where the stock market goes, as long as our long-term direction, whether from government or private sector, is correct. To your specific question on capital gains tax, today there is no consistency in tax rates or holding periods for different types of instruments, which fall even within the same asset classes. Even when you look at indexation benefits, these differ in different situations. The tax rates, as we know, for residents differs from non-residents. So it's really that a lot of these changes have happened over the years. Now, keeping in mind the significant growth opportunity that India presents over the next decade, we need to attract all kinds of capital, whether it's equity, whether it's debt, whether it's domestic, whether it's foreign. And to do this, we need a simpler structure and a simpler regime. And that is what, as CII, we have suggested. We have to also keep in mind that we are very much a part of the global market. And while India has stood out in stability and resilience in this period, but we are not so isolated from the international markets that our own stock market will not react to that. Hence, it's important that whether it's government or private sector, we focus on doing what is the right thing for high quality growth, for high quality jobs, boosting infrastructure, boosting private capex, boosting agriculture. Because this is not for a year, this is for the next decade at least. And as we do this, everything else will align itself in time.
Bajaj, you understand consumerism. That's what you do at Bajaj FinServ and Bajaj Finance as well, right? Have you started to see any uptick when it comes to consumerism? And then to build on the momentum of that, what is it that the budget can do? Is it the obvious stuff? Maybe look at tax slabs again. There is so much buzz that maybe we will see that take place, particularly for the lower end.
So as far as the uptick is concerned, we are starting to see a strong uptick coming in rural areas. In urban areas, we saw that a few quarters ago. It has moderated a little bit. And that's again a reflection of where we stand, where inflation has hurt people's pockets in the last few quarters. And, what is very clear is a K-shaped recovery, where we are seeing that upper middle class and above are buying, continue to buy more, but it is the low middle class which has suffered. And that's the reason why on personal income taxes, we are asking for a review of that for just this section of society, because they've been hurt the most. We see that in their purchasing behavior, that is clearly down compared to earlier years. And that's why we are hoping that the budget will look at this.
Chandrajeet Banerjee, coming to you now. Good to have you back on ET now. It's certainly been a while. Having said that, we've heard from both our Sanjivs, Sanjiv Puri as well as Sanjiv Bajaj, on some of the major areas that the Central Exchequer should be focusing on to get the animal spirits back and to ensure that this is India's decade and we see a growth rate of 10%. Chandrajeet Banerjee, you are the Directorate General of CII. You want the government to maybe hike its expenditure once again by 25%. Now, we have the likes of Kumar Mangalam Birla saying we are in the Mahakumbh of a capex cycle. But be honest, be candid. As the DG of the top industry chamber, is India Inc. ready to step on the gas and do its bit when it comes to private sector investments?
We see the confidence index somewhere around 67.6, which compares to 62, which is the highest in 2 years. Let me put it that way. Again, with the resumption of the business activities, the expectation for October, December quarters, there was a major improvement on that. And about if you really look at the capex of the present capex situation, we had about 80% of the respondents saying that their capex are somewhere around 75%, which is a significant majority. So what we are seeing, in line with the latest first advanced estimates of the GDP for the current fiscal, which have put the GDP at about, we are looking at a 6.5 to 7%. We are seeing many sectors which are moving ahead of anywhere between 75-80% of capex. So the reason why we are really looking, therefore, as a stronger spend from the government, because that will really bring in, and I see that the next quarter with as you know, we have all come back from Davos. We're hearing there is America is going to have a pickup by the middle of the year. We are seeing strong signals of good amount of opportunities. I see the private sector capex coming into play very soon if the momentum from the government is kept on like the way it has been kept on and the way we are expecting, as it was said. So I see good opportunities. Many of the sectors are already picking up. The construction sector, Sanjiv spoke. FMCG, we are seeing an upswing. We are seeing steel. So many of the sectors are actually going up. So I'm pretty confident that the private sector will come in. And as you were saying, animal spirit, I guess that it's a matter of time when we will see the private sector really expanding its footprints on further investments.
Dinesh, if I can finally come to you, what is the big idea from CII as far as manufacturing goes? This is a government which is talking about being Atmanirbhar, being China Plus. But is the idea stopping at PLI schemes and basically just having more PLIs for sectors? Because that's what it seemed like when I read the CII memorandum too.
No, I think there are two ways to look at this, right? I mean, obviously, if the economy is going to grow, we need further investment in manufacturing. And the two elements one was that it's an alternate to some other country. But I think equally, there is a domestic demand. And if I look at both sides of the spectrum, I think we are now, I would say, ideally placed because we have come out of COVID much stronger than the rest of the world. We have many companies which are looking at India as an alternate. And therefore, I don't think the budget needs to do something dramatically different from an approach to the manufacturing sector, other than making sure that we implement the PLI schemes which has been talked about.
Sanjiv Puri, if I can now come to you as back.
When it all